Hey everyone, welcome back to Corporate Decoder. Today we're diving into some juicy corporate drama, a case of he said, she said between two banking giants. Stick around because this 8K filing is more than just numbers, it's a window into a merger that's hitting a few snags. This report revealed lawsuits and accusations flying around regarding a proposed merger between Columbia Banking System and Pacific Premier Bancorp. Someone is claiming information was hidden and people want more details disclosed. It's getting messy. Don't forget to join the Discord channel for live analysis and much more. Alright, let's start with the basics. This is a Form 8K filing which companies use to report significant events to the Securities and Exchange Commission, the SEC. Think of it as corporate gossip, but filed under oath. This document tells us about some lawsuits and demands regarding a planned merger. This filing is all about a planned getting together, a merger between Columbia Banking System and Pacific Premier Bancorp. It's a big deal and it was first talked about back in April of year 2025. The plan, Pacific Premier, would merge into Columbia, but now some shareholders are throwing a wrench in the gears. Several lawsuits have been filed making claims that not enough information was shared or that what was shared was misleading. These lawsuits name Columbia and Pacific Premier along with their directors as defendants, the people being sued. The plaintiffs, the ones suing, want to stop the merger until they get more information. They are claiming to be missing key facts. Not only are there lawsuits, but the companies also got demand letters from shareholders. These letters say the same thing, that important information was left out of the documents related to the merger. These omissions or things left out are believed to be in violation of securities laws. To avoid trouble and expense, Columbia and Pacific Premier are adding some extra information to what they already shared. They say they don't think this extra information is required, but they're doing it to keep the peace and avoid a long legal fight. Here's one thing they're adding, more detail on how the Columbia Board of Directors decided to continue exploring the merger with Pacific Premier. It includes analysis of the potential transaction. According to the filing, the Columbia Board expressed support for continuing to explore the potential transaction with Pacific Premier. There is also some more information on a meeting in March of year 2025 where representatives from a financial advising company talked about Pacific Premier's financial situation, potential risks, and also the potential pro forma ownership split. A pro forma ownership split is how the ownership would be divided between the two companies after the merger. Here's the strategic element of the transaction. The key focus is expanding Columbia's presence in Southern California, something Columbia was already trying to make happen. Columbia management discussed the timelines for realizing synergies, the benefit of the deal, and systems conversions. The compatibility of practices, including its board culture, is also discussed. The board approved Columbia management to negotiate. Pacific Premier contacted other companies about a possible deal, but none of them panned out. They each said now wasn't the right time. So Pacific Premier moved forward with Columbia. Additional information on a Columbia board meeting is shared. Apparently representatives of a company called PSC provided an overview of the transaction from a financial perspective based on the exchange ratio. The board support continued. Let's get to the real meat of the matter, the financials. One of the key updates in this filing involves the list of companies used for comparison to Columbia. These companies had assets from roughly $35 billion to almost $90 billion. It also shows the efficiency ratio. The efficiency ratio is how well the bank uses money to make more money. The lower the better. Here's the peer group. People they compared themselves to for Pacific Premier Bank of California, First Interstate, Glacier Bancorp, Wafod, Bank of Hawaii, and a few others. Again, we're talking banks with assets of roughly $15 billion to a little over $33 billion. Key numbers to consider here are things like price compared to core LTM EPS, or earnings per share, which gives you an idea of how much profit each share of the company is making. The document then dives into similar banking mergers. This includes transaction dates, deal values, and key elements of each deal. This can give insight of how successful previous large banking mergers have been. Looking at the deal history, the prices paid here range quite a bit, some less than $1 billion, some more than $2 billion. To compare that to this deal, you need to understand it's roughly over $2 billion. PSA did a net present value analysis looking at how much Columbia common stock is supposedly worth. These price to earnings and tangible book value multipliers were based on a PSC review of other matters, the trading prices of selected companies. The analyst calculated discount rate of Columbia is 11.07%. This means the rate is high, which can be seen as there is a risk involved or higher return involved. The price to earnings that PSC chose were based on trading multiples of Pacific Premier. The analyst calculated discount rate of Pacific Premier comes out to be 11.57%. More details on the assumptions used for the numbers for the company are shared. The expected earnings per share and tangible book value change is shared. Then another table of mergers is shared. Here's a little secret from the document the company wanted to hide from you. The difference between the lowest and highest price in tangible book value mergers is roughly over double. The one-day changes also shifted from roughly nothing to almost 30%, which can show the mergers are very hard to analyze. This document admits that the deal could reduce Columbia's tangible book value per share at closing. The merger is based on capital asset pricing model implied cost of capital calculations. And what that means for you is that there is a risk in value. Pacific Premier agreed to pay KBW a large chunk of money, more specifically roughly $22.5 million, from which $2 million was already paid. In other words, these advisors and companies already made millions of you even agree. Of course, there's a section about risks. These include things like general economic conditions, changes in interest rates, competitive pressures, and the success of Columbia's and Pacific Premier's business strategies. It's the usual list of worries that could throw a wrench in the works. If you want to read more, all you have to do is to read the annual report or quarterly report. And of course, the document also identifies the people who are participating in soliciting the proxy. That is, the people trying to convince you to vote a certain way on the merger. Now, looking at the situation, it's clear this merger is far from a done deal. The lawsuits and demands for more information suggest that some shareholders aren't happy with what they know. And in conclusion, it is all risk on both companies and shareholders' parts. The companies are willing to pay millions, and it has a chance to dilute share prices. It is just based on faith on models. Alright, that's our deep dive into this 8K filing. What do you think about this proposed merger and the legal battle surrounding it? Drop your thoughts in the comments below. If you found this helpful, hit that like button and subscribe for more corporate decoder content. Don't forget to join the Discord channel. Thanks for watching, and I'll see you in the next video.